Hi, so today I'm going to share a little strategy with you that I use. It's called the dividend capture strategy. It's a kind of wealth strategy. It's a way of enhancing the yield from your investment portfolio, or creating extra capital that you can invest into more income. If you have private wealth banking, this is dead straightforward. Your private banker will organise all of this for you. They'll get all the quotes, they'll set up all the trades, and they'll do everything for you based on your instructions. If you don't have private wealth banking, you can emulate this strategy using things like interactive brokers and Saxo. You really need to understand options, particularly how you place a covered call option. But this is something you can educate yourself about if you think this strategy sounds a little bit interesting. So let me just run past how I do this, because I literally placed 2 trades today, so it made me think of this, and I thought, I know, I'll do a video on this topic. So what happens is every share that issues a dividend has an ex-dividend date, and that's the date by which you have to hold the share in order to qualify for the dividend. Now in the US, most dividend paying stocks actually pay their dividends quarterly. I mean, they can vary, but most of the really big ones, so your Coca-Cola, Unilever, Goldman Sachs, all of these guys are paying quarterly dividends. So there's 4 times a year you can do this strategy. The 2 stocks I bought today were Abbott Laboratories and MasterCard. It tends to be always the biggest, most stable companies that you can do this with, because they have a good options market and they have a reasonably robust dividend payment strategy. Now the premise is that basically on ex-dividend date, if you hold the shares, you qualify to get the dividend, so you capture the dividend. But what the exchange does, where it's listed, is it corrects the price of the share by the amount of dividend that's been issued. So what they do is they take the overall market cap and they reduce it by the amount of dividend that's been paid out. The rationale is that that company now has less cash, therefore you should qualify for less overall valuation. Now, of course, what tends to happen is that very quickly people buy the share back up to its original price. And in fact, if you go to dividend.com, which is an excellent resource, and for not that much money, you can have their premium version. That enables you to drill down into things like how many days on average does a stock recover after ex-dividend date. So typically you want businesses that recover in, share prices that recover in, say, 3 to 5 days after issuing the dividend, so they're back up to where they were. Effectively what happens is those 2 shares, I bought them because they went ex-dividend, they go ex-dividend tomorrow. So I buy them now, they go ex-dividend with me as a shareholder. And then what happens is the share price dips a little bit, and within a week or so it's recovered, and you could sell it and you've just captured the dividend portion. Now, depending on what company it is, that can be somewhere between 1/3% to 0.8%. But here's the little twist you can add to this is you can sell a covered call back at the recovered price. Now, a covered call is an option which basically says, let's say you buy it for 90 cents and the recovered price is 95 cents. The covered call would say, when it gets to 95 cents, I agree to sell to the covered call holder. So it automatically sells it when it gets to 95 cents. The great thing is the moment you take that covered call, it pays you a premium. Now, on most of these big names that we do this with Microsoft, Goldman Sachs, people, these large companies, you'll often find you can get that option premium somewhere around 2 to 2.5%, 1.9, 2.4, 2.3, sort of amounts like that. Add on the dividend capture component, so the 0.3 to 0.8% that you've captured on the dividend, and you're getting about 3%. Now, what's interesting about that is that I'm recording this on the 6th of July. Options contracts expire on the 19th of every month, or closest working day, more or less. Effectively, I only need to hold MasterCard and Abbott Laboratories. I only need to hold those until the 19th of July. So they will sit in my portfolio for, a matter of days, a little over a week. So it's a very short period of time that you're holding the direct equity position. And in that very short space of time, you're capturing maybe, 3% return. Now, I actually do this using Lombard or leverage on the main portfolio. So my main portfolio, which is generating all of the income, you literally just draw down some margin, you acquire these shares, and then when they sell again, it replaces the margin plus the little premium that you've managed to clip on it. So in fact, if you buy something like MasterCard, that has a loan to value of 30.70. So for every 30 cents you put in, you can buy €1 worth of it. And Lombard lending is 0.7% a year. So if you look at the leverage, you're taking your 3% and roughly tripling it. So you're getting about 9 to 10% return in that 2-week period. And you're borrowing that money at 0.7% per year. Now, obviously, you don't want to go mad with that strategy. You want to use it just a little bit of your kind of portfolio margin, not go full bore. When you do options contracts, you have to buy 100 shares as a minimum. So I bought 100 MasterCard shares and 200 Abbott Laboratory shares because Abbott Laboratory's a much lower share price. So you just take this little clip, you make your 3% or 10% leveraged return in a couple of weeks, and then next quarter you can do it again because that same stock will come up again as the option to do this. Now, the great thing about this strategy is, the risk is that if there's a market correction while you're owning the stock, because then the price goes down and you're unable to meet either the covered call or sell it back for the price that you paid for it. But the good thing about this is that you're only owning these shares for a very short space of time, 4 times a year. So you'd almost have to be quite unlucky to own them at the time there was a correction. But on the plus side, I tend to choose, because of the options element to this, you tend to choose the much better performing, much bigger, much more interesting shares. And I also cross-reference the Dividend.com list. They actually have a dividend capture list in that website. I compare that with the Julius Baer recommended list. And so anything that's a buy on Julius Baer and in dividend capture and has an option premium more than sort of 1.5%, they get screened out, and it comes down to probably about 3 or 4 stocks per month that you can do this with. Sometimes it's a little bit more, but generally it's that sort of number of shares you can do. So you can just have this ticking away in the background, and it doesn't take a rocket surgeon to figure out that if you're making 10% in 2 to 3 weeks, and you can do that 4 times a year, that's a 40% return on that sort of play money bit that you're adding to your portfolio. So when you add it up over time, it's actually quite a nice little extra yield enhancer or contributor of additional cash. Like I say, if you don't have private banking, it becomes a little bit of an active strategy. You have to trade, and I don't think I'd have the patience for it personally because I'm busy doing other things. But if you do have the capacity, or you trade options anyway, and you understand that space, I think it can be quite an interesting little thing to play around with. Remember, none of this is financial advice. It might all be made up and complete nonsense. I don't want you to get in trouble, but yeah, do some research. It's quite interesting. Dividend.com's premium account will show you the dividend capture kind of tables. It's very easy to find out if stocks have buy, sell, or hold ratings on them. You can look through all the various different ratings agencies out there, and yeah, using the options, you can enhance the return that you get from these stocks. So I'll leave that with you and see if you like that idea.